issues about morality, because I'm looking mostly at the law, but let's start with the morality, and particularly the point Andrew made this morning, I think. Companies say we only follow the rules. Well, to a lawyer, it's not a matter that government passed the rules and the rest of us obey them, especially when it comes to big business. In fact, what we know is that business is very active in lobbying to help to write the rules. And law is actually a continuous process, not a matter you just pass the law and then everybody obeys the law. There's a process also of interpretation of the law. Law is a social process also, and what the rules actually mean is informed by those kinds of interactions, where actually professionals, lawyers, accountants also, are in the thick of it. So I don't think you can separate, as I think the discussion this morning showed, morality and law, but equally you can't separate the role of professionals from what the law is as well as what the law should be. We influence what laws are passed, and business is behind that. It's true to say governments are responsible for the rules, but the term I think in Anders' slide was not government, but governance, which is much broader. Okay, we have governments, we have politicians, but frankly, how many politicians actually understand the text of tax bills that are put before Parliament? They don't get that much time. They're generally drafted by civil servants. As I say, there's a lobbying process behind drawing up legislative proposals. So governance is a much broader process in which I think we're all involved. And governments, politicians in particular, come under a lot of pressure when they're proposing, when proposals are put forward to change the law in a way that business doesn't like. And often they're afraid of the power of big companies. And as I say, the legal rules are not just bright, they're not just, thou shalt not kill. That sounds obvious, but whether you've got complexity, hundreds of pages that Andrew was referring to this morning. In fact, international tax rules aren't hundreds of pages. The basic international tax rules are in tax treaties, which are quite simple, but they're phrased in general terms, and they've a lot of rules for interpretation, and the interpretation is where the professionals come in, and where also the business lobbies come in. Also, why are we concentrating on companies? Because tax on profits, income or profits, particularly if it's profit which comes from capital, from investment of capital, in a number of ways it's much easier to avoid. Again, this morning I think there was a mention that if you're talking about employment income, PAYE just deducts it, and there's very little scope for avoidance, I think, of income tax on employment income. It's quite different, I think, on income from capital. Firstly, it's applied ex post. It's not deducted at source. Applied to transactions which can be structured. So you have to think about how to structure the transaction, and that gives a lot of scope for science. It's not routine or spontaneous transaction. And the whole concept of income is an abstract concept. In fact, I don't think it's ever been defined in tax statutes. I don't know how accurately it's defined in accounting rules are. You can probably tell me quite a lot about that. But it's possible to alter the timing, the recipient, or the amounts of flows of income. And in the international context also, the international allocation of tax rights depends again on abstract concepts of residence and source, which are open to interpretation. So the law is not necessarily clear. You know what you should be doing, and that's what you should do in the representation of the rule of law. There's room for interpretation, and within that room for interpretation, you necessarily have to have morality, but also issues of values. It's not just do good, but it's also think how you want the world to be structured. So the whole issue about tax planning, and the term that's often used now is aggressive tax planning. What counts as aggressive tax planning? How far can you go? Morality comes in, as we discussed this morning, and even if you're just looking at the bottom line, there are issues about reputational damage. But I think we've covered most of that. So I'm going to mainly focus on avoidance, the middle element in Andy's slide earlier, and why transnational corporations. Obviously, companies now are particularly concerned about the direct revenue losses after the financial fiscal crisis, austerity. People want taxes to be set. And it's only really now that international tax rule-making bodies have started to talk about double non-taxation. Most of the history of the development of international tax rules, the main concern has been to ensure you prevent double taxation. And the negotiators of tax treaties have generally put the emphasis on that. They've seen international direct investments through multinational companies as a good thing. So they've tended to emphasize preventing double taxation. And it's only relatively recently, with a lot of the publicity, and as I say, following the fiscal crisis, that they're now starting to talk about double non-taxation, or another phrase that's used is stateless income. So you now do have a situation where really enormous sums of retained earnings are available to companies that apparently they don't know where to invest. The estimate is, I think it's now actually up to $2 trillion for US companies. We tend to know more about those because of SEC filings, but I think companies based in other countries probably have equivalent sums. Okay, that's the top line, but there are many other reasons to focus on international tax avoidance. It undermines the general legitimacy of taxation, as I've already said. It actually distorts competition. The advantage is that it gives internationals against domestic business, against, Anders mentioned that, if ordinary Zambian companies are having to pay the tax, and foreign companies have that unfair competitive advantage, that's a distortion of the market system. But also the facilities that are being used are the tax havens, are the offshore secrecy system, which in fact was largely invented for multinational companies. And that's also used for very many other, some of them legal activities, for example shadow banking, but some of them criminals. So it legitimizes that whole offshore haven and secrecy system. So there are very many reasons really to reform international tax rules. And attempts have been made to do that. If we look back in the last 20 years, 20 years ago now, almost, anyway, 1996, first initiative, recent times, went through what was then the G7 group of world leaders. And that stage, Russia hadn't been admitted, so it's still 7. And that led to a report on harmful tax competition. Although the initiative came from the politicians, the top world leaders, they handed it over to the technicians who do most of the international tax rule writing, and that's the Organisation for Economic Cooperation and Development, the OECD, which since the 1950s has been responsible for drawing up the model tax treaties, which are used as a basis for bilateral treaties. So really, if we say, well, who's responsible for writing the rules, it's not the politicians, it's the tax experts at the OECD. And they tend to be government officials, they tend to be top HMRC or Treasury officials. So the issue was handed over to the OECD, which published this report on harmful tax competition in 1998. But that was very quickly derailed. There was a shift in administration in the US. And again, some lobbying on the new Bush administration to say, well, tax competition is a good thing. What do you mean? You know, the pressures were, we want tax competition. And that led to the US withdrawing its support from a substantial part of that initiative, and it then got refocused to a process of trying to improve exchange of information between the tax authorities. And although they started with a fairly broad remit, trying to get a multilateral arrangement, very quickly it became negotiation of bilateral treaties with some of the havens. Already at that time, many of the tax justice organisations which had started from the 2000s, some of you may remember there was I think probably a turning point was an Oxfam report in 2000. And then Tax Justice Network that I work with now was started in 2003. From the start we said that was inadequate. What we needed was a multilateral treaty framework for comprehensive automatic exchange of information. The OECD still ploughed on with these bilateral treaties. It's only finally this year that we have at the G8 what they call the Loft-Earn Declaration, where they have now very firmly, finally after 15 years, set down a standard as being comprehensive, automatic, multilateral exchange of information, plus, very importantly, as Anders mentioned, the establishment of beneficial ownership registers in all countries. And the UK is doing that not only for the UK, but also very importantly for the UK dependencies, many of whom are tax havens, British Virgin Islands, as I'm sure many of you know, also the Isle of Man. I'm sorry, Andrew's left now, but those dependencies very much secrecy centres, and the UK has now signed up to the multilateral treaty that actually the OECD and the Council of Europe agreed in 1988, which the UK didn't itself ratify until I think it's 5 years ago now, but now is signing up those dependencies also, both to the multilateral comprehensive exchange of information, but also to setting up beneficial ownership registers, so that we might start now over a period of years. But that's now the standard. There's going to be a long process, and I'm sure there'll be a lobbying process. Cayman Islands just issued last week, you may have seen, a call for comments on their proposal to have a beneficial ownership register. And that's quite important. The US doesn't have ownership registers for companies, so that's the reason why Delaware, as again Anders mentioned, is a secrecy centre in its own way. In the US, as you know, companies formation is at the state level. I think only a couple of the US states have any beneficial ownership information. So finally, belatedly, public pressure has forced the political system to try and take this issue on. So that gives you a bit of a background as to then what is facing us in reforming the international tax rules, which again came on the agenda this year, first through the G8, but now more importantly through the G20, the bigger group, which following the financial crisis now has brought on board some of the bigger developing countries, China, India, Brazil, Argentina, and Saudi Arabia, actually. So now the initiative's been taken up through that. And in September last year, the G20 meeting in St. Petersburg had a tax annex. So I recommend you have a look at the tax annex. But those are the kind of headlines as regards tax. So they've now given a mandate. But again, it's gone back to the OECD to establish tax rules, in particular, to ensure that profits are taxed where economic activities occur and value is created. That's the principle now. Now, why does the existing system not do that? It goes back really to the first formation of the tax treaty rules in a conference organised by the League of Nations in 1928. And the rules that they drew up there was in a period where international investment was largely portfolio investment, where you had investing in one country, investing in a business in another country. So it seemed logical to split tax jurisdiction between the country of residence of the investor, which should be able to tax the returns to the investor, interest or dividends, and the country where the business is located, which should tax the business profits. There already was some foreign direct investment. There was some multinational companies even like General Motors and Ford had already set up in the UK, for example, and in other European countries in the 1920s. There were mining and oil companies already. So they adapted that basic rule for foreign direct investment by introducing into the treaty the so-called separate entity principle. And that said that the different parts of the company should be treated as if they were independent entities. But this was understood to be a fiction. Already in the British tax rules going back to 1918, there was already a power for the revenue to adjust the accounts, because it's obviously a fiction. From an economic point of view, companies, multinational companies, transnational corporations are operated as unitary entities. But the separate entity principle in the tax rules really go against that. And in the post-Second World War period, really, that was when you had the most rapid growth of foreign direct investment and the expansion of transnational corporations. And they started to develop, exploit, you might say, the separate entity principle, which actually doesn't just allow, but it encourages so-called profit shifting, using exploiting, if you like, the concepts of residence and source by setting up conduits, for example. So you can set up conduits in the Netherlands or Switzerland to channel funds. Anders has given you some examples, through usually to base havens, which would be zero tax jurisdiction. And then subsequently also taking advantage of preferential tax regimes, like Ireland. Ireland began with 10-year tax holidays, then under European pressure shifted to its 12.5% tax rate. but has a lot of other advantages which it can offer. Now, those responsible for the tax rules did start to introduce anti-abuse measures, if you like. First they looked at, first they looked at control foreign corporations. So I'll jump transfer pricing, but come back to it. In order to combat the use of these conduit or haven companies, they said in some circumstances, and this was first introduced by the US back in 1962, in some circumstances you could disregard the separate entity principle, but they had to define the circumstances because the treaties very firmly said separate entity. You had to treat each entity as separate. They said if you could do so, if a company was under control, you have to have a control test, which is normally a combination of legal ownership and decision making. Secondly, if it doesn't have an active business, you have this passive income kind of concept. And thirdly, it's located in a low tax jurisdiction. Now that, as I say, was introduced first by the US and then spread to a number of other OECD countries. But as, in particular, preferential regimes came in, it became harder to operationalize all of those criteria. In particular, the passive income test is harder and harder to operate. Anders pointed to, for example, Mauritius or Netherlands and office buildings. The Netherlands now is asking for comments on its rules, but you could argue that there is some kind of activity going on in some of these Dutch companies in that they're managing intellectual property rights. In Ireland, for example, which is used, as we've already mentioned, by Google, for example. Google's Irish company is apparently responsible for the sales of advertising around the world. Now, I'm sure they have some back office operations in Dublin. They employ, I think, roughly the same number in Dublin as they do in London. The ones in Dublin are administering, as I understand it, Google's advertising sales, but basically they're signing off on contracts. And the ones in London are supposedly only doing marketing. I don't know if some of you may have seen a newspaper report, I think it's a Reuters journalist who followed that up, and found a lot of businesses who said, well, as far as we know, we deal with the London office, they tell us what their advertising rates are, and tell us why we should go for Google and so on. But when it comes to signing the contract, you sign it with the Irish company. But as many people are employed in London as they are in Dublin, and yet Dublin actually is responsible for the worldwide sales, sales of advertising for Google in India, China, everywhere else outside the US really, go through Dublin. So it's difficult to treat the Irish company as a pure sham. It does do something, i.e. back office functions to sign off contracts. You can't really say Ireland is low tax, 12.5%. It's lower, but it's not zero. So it's hard to treat it as a controlled foreign corporation. So CFC rules have become harder to apply. Going back then to transfer pricing, in the 60s again, they started to introduce rules to try and guide the adjustment of it to corporate accounts. And they introduced 5 different possible methods, which were approved by the OECD. But a lot of countries didn't have any transfer pricing rules. In recent years, more and more have brought them in, and the more developed developing countries, again like Brazil, India and China, are operationalizing their transfer pricing rules. And what you're finding now is that they all use different methods, although there's this wide range of methods. So in fact, the international tax system really is crumbling. It's really, the system has grown up rather accidentally, not very well designed, and is now really many people agree, largely broken. So now, following that mandate from the G20, the issue has been handed over mostly, as I say, to the OECD Committee on Fiscal Affairs, which is mainly responsible for the current system. It produced an action plan on base erosion and profit shifting, so we now have the acronym BEPS. The BEPS action plan was published in September, or July, I think, but anyway, approved in September. And it's supposed to produce proposals over the next 2.5 years, with deadlines this September, next September 2015, and finally December 2015. But in this whole process, there are extensive consultations, and surprise, surprise, at the consultations, what you get are the tax planners, the big, particularly large accounting firms, the law firms, the business lobbyists like BEPS. I think one we went to, quite an important one we went to on country-by-country reporting and transfer pricing. There were 4 civil society organisations in the room, and probably a couple of hundred tax planners and tax advisors. So they're not just going to passively obey all the rules, whatever the rules the OECD comes up with. They're very actively lobbying to make sure the rules are what they would prefer them to be. OECD is going to try and consult more broadly, and they're having consultations through developing countries as well, particularly regionally. But how far they can take on board those other points of view we have yet to see. Now there is still a UN Tax Committee which was refounded in the 1960s, but has largely spent its time really following on from the OECD. What it does, it tends to do is to tweak OECD rules to try and make them a bit more suitable. And in particular, it's greatly hampered by having hardly any resources. It has basically 1.5 full-time equivalent professional staff, where the OECD has, I think I heard somewhere 160. It certainly has many tens of specialist staff. So the UN Tax Committee is really hampered by having really inadequate resources. But it has set up a subcommittee on the BEPS issue. We've also got the International Monetary Fund that has a research department but doesn't have a policy role. So that's the governance, if you like, of international tax. I'm going to briefly go over the BEPS action plan to give you an idea of how they're approaching it, but obviously I haven't got time to go into it in much detail. But basically what they're proposing to do is to strengthen the existing rules. They say that they haven't got a mandate and they haven't got the time to redesign. And I'll explain briefly why we think they should. So it has 15 action points, and basically, as I say, they're tweaking the existing rules to try and strengthen them. Given the time, really, I don't think I've got time to look at in any of those, but if any of you know any international tax and would like to pick up on any of the particular points, we can do that. Now, it may well be that they will seriously strengthen the rules. They do seem determined. They are under a lot of political pressures. They know the system is broken. Our view is that if they do that, as they strengthen the rules, because the basic foundation of the rules is this separate entity principle, what you'll have really is more confidence that each country will apply what one of the rules increases its tax take, and that will lead to increasing confidence. Permanent establishment rules, for example, is the rule for a tax presence in a jurisdiction. If they do broaden that out, which really they should, to take account of internet sales, then clearly more source countries will be asserting jurisdiction to tax. If they strengthen control foreign corporation rules, then it will be the residence countries. So that patchwork approach, in our view, really will make the system even more conflictual. Probably the most hopeful area is the mandate that they've now got from the G20 to establish country-by-country reporting. What they're doing about that is to propose a country-by-country report master file that every multinational company should now prepare. Master file, which the purpose of it is now being debated still, but it's seen from an OECD point of view very much as a transfer pricing risk assessment tool. But it will now, very importantly, I think, give the possibility for every tax authority to have an overview of the company as a whole, rather than just the account of the particular affiliate in its jurisdiction. So that Zambia, for example, in relation to ABF, until now, would normally only have had the accounts of the Zambian affiliates, and wouldn't have all this picture that I guess ActionAid had to build up by looking at the accounts of the company around the world. And they don't necessarily have the resources to do that kind of detective work. But now this country-by-country report, in principle, ought to give them that kind of an overview. The debate's going on about what should the content be. It should provide details about all the affiliates in each country, details of intra-firm transactions, details of the financing, including derivatives, and the financial performance, in particular profit, but obviously there's a question there, how should they be defined? Should it be by country or business segment? Should it be on a financial accounting basis? So which financial accounting basis? As you I'm sure know, financial accounting is rather different from tax accounting, and is not normally considered suitable for a tax basis. But there are a lot of issues there now being debated and under consultation. The OECD, as I said, had a consultation about that last November, and they're going to come out with proposals next month, and a further consultation meeting, I think in March or April. So that's all being debated, and also the question of to whom should that report be submitted. In principle, it should be to every tax authority, but again, the lobbyists are saying very strongly they might be okay with giving it to their home country tax authority, but they only want it shared under strong protections of confidentiality. But there's nothing to stop any country's legislators from requiring any company operating in their jurisdiction to produce this report. So I think sooner or later companies will have to do it. And I think it will be a game changer for international tax, because as I say, for the first time, every tax authority where a company has a business presence will have that overview. Now that will then shift the attention to the issue of transfer pricing. Transfer pricing is really where the shoe pinches, if you like. I don't myself think it's the main problem. It is a very big problem, but profit shifting by using conduit companies is really the underlying problem. But it's where the shoe pinches, because in theory the pricing of these transfers is really where the profit shifting takes place. And the mandate, as I've already said, is for the OECD to try and ensure that outcomes are in line with value creation. In particular, the issues focused on intangibles. And obviously they're very important, particularly now we're in the so-called knowledge economy, post-industrial, even industrial firms are highly dependent on design, high technology, and so on. So all firms really are quite intangibles based. You also have services companies which in a sense deliver intangibles. So intangibles clearly are central. But the notion of intangibles often is thought to mean something almost concrete, intellectual property rights usually. But in practice really that's not how knowledge within a company is generated. So it's been a big issue in the OECD transfer pricing guidelines ever since they were first drafted. Back in 1995 was the first version that was actually called guidelines. And they've only really in the last few years decided to take another look at it. But this does predate BEPS, so since 2010 they've been revising the intangibles rules. And what they now say is that they want to shift away from which entity is the legal owner. But nevertheless, the proposals still say you should start from the legal owner and just adjust based on what they're calling functions, assets, or risk. That focuses on the issue of control of research and development. In our view, that is still a mistaken approach, because as I say, knowledge within a company is much more organic. The example was given of Glaxo. The Glaxo dispute was actually exactly about that. Glaxo was at that time a British-based company, and this was a Zantac drug. The initial research for which had taken place in Cambridge. So Glaxo and HMRC, or the Inland Revenues, I guess it was, still was then, took the view that that meant that the bulk of the royalties should come back to the UK. The Americans said that the US profits were much more attributable to the US marketing intangibles. And if you look at how big drug companies operate, they spend far more on marketing than they do on actual research and development in laboratories. It's cozying up to the doctors and giving them out all the freebies and all the rest of it that actually is the source of the profits of the drugs. Zantac didn't have massive sales in the US only because it was a wonder drug invented in Cambridge, but also because of the vast sums of money that Glaxo put into the marketing. And I think that really shows you the organic nature. And in fact, in the intangibles consultation last autumn, I thought a very interesting contribution came from BASF. Most of the comments that went in were from the tax planners. This was one of the few directly from a company. And BASF said, essentially, and I recommend you to have a look at it, that the way they organise innovation is very organic, and it's done through computer-based systems with their technicians really spread around the world. And it's impossible really to tell even where that is controlled from, let alone which particular part can be said to have originated a particular innovation. So I think the OECD really is still a bit barking up the wrong tree on that. They're also going to look at finance and other high-risk issues. And that still leaves the question of which of the 5 approved transfer pricing methods should be used. And again, if you read the draft, we're still not coming clean at the moment. We look forward to seeing what they come up with next month. But at the moment, they start by saying any of the 5 can be used. However, the resale and the transactional net margin method, which are one-sided, I haven't time to explain the details of that, and inappropriate. And comparables don't really exist. Reliable comparables in many cases are difficult or impossible. In fact, what they come back to, and increasingly one finds in transfer pricing, the method they resort to is so-called profit split. Now, profit split does entail aggregating the profit of the related entities and splitting them according to what they call drivers, appropriate drivers. But it's never been systematized in the OECD approach. They don't say at what level of aggregation, on what accounting basis, anything like that. So they do say you should look at consolidated financial accounts. I think the profit and loss is what they look at. You can tell me whether that's right or wrong. But financial accounts, as we know, are not normally accepted as suitable for tax purposes. So although they're pushing towards using a profit split approach, it's not been systematized to any extent. So the documentation requirements now, I think, are leading them to a position where they will be able to get an overview, but they haven't really got any systematic method behind that for making that possible. So really, it's still very much, I think, of a dog's breakfast, as our view. Now, the alternative that we have proposed to, I think briefly mentioned this morning, is to switch away from the separate entity approach towards the approach that is based on the economic reality that transnational corporations, multinational companies, are unitary companies. When we deal with Amazon, Google, whatever, we think that they're one company, not 100. You accountants probably know that there are 100 behind, because you do all their accounts. But most ordinary people think of them as a single company, and they're clearly centrally directed. And that was always known back in the 20s when they were looking at the tax rules. They knew that. And you already had federal states that used a unitary approach. And the more you have market integration, the more a unitary approach is really the only logical one. And within the EU, since the 2000s, they've realised that there has to be that approach, and the European Commission started to develop a common consolidated corporate tax base proposal, which they had ready when the fiscal crisis hit, and they were asked then, what have you got on the stocks? They produced a common consolidated corporate tax base that had been developed in close consultation with accounting bodies and others, and is now under consideration by the Council of Ministers. So again, I haven't got time to go into that in detail, but proposals are there. And what we argue is that it's possible to move towards a unitary tax approach on a gradual basis. Firstly, what you need for a unitary taxation approach is what we would call a combined country-by-country report. So we hope that the mandate now given to the G20 will start to look like this, which should include some form of group consolidated accounts. Now, again, there's a lot of debate to be had, and I'm sure you could all engage in it about on what basis do you aggregate upwards from existing affiliate accounts, and on what basis. So that's quite important. And then also to have data on the country-by-country presence, the real presence. What you need is data on the physical presence, physical assets, employees, and sales, as well as taxes paid in each country. And as I said, we're on the way to that. Secondly, probably the most important key feature, and this is probably the biggest stumbling block, is there needs to be some agreed system of profit apportionment. Now, although this would be a new approach, it can build on what is already there. It can build on, as I've already said, the shift towards profit split, which has already been there for 20 years. What's important to note is that this apportionment method isn't trying to attribute where is the money earned. If you look at take the Glaxo example, it's not saying, are the profit earned? Were they earned in the Cambridge laboratory where that research was done, or in where we did the marketing or whatever? It's trying to attribute the profit according to the actual presence of the company in each country. So the drivers that have been used in federal systems like the US system and proposed in the European Common Consolidated Corporate Tax Base are physical assets, not intangibles, because they are intangible, they can be shifted about, but also because they adhere, they are inherent to the company as a whole. Employees, which can either be numbers, headcount, or cost, payroll. Within a federal system like the US, they use payroll, but there you've obviously got a more or less homogeneous level of wages. Within the EU, because of the bigger wage differentials, they've suggested a balance between headcount and payroll costs. And sales usually by location of customers, because on the one hand, the physical assets and employees' payroll are production factors, and sales is a consumption factor. So combining the two gives you a combination of production and consumption factors. Because however much a company produces, it can't make profit unless it sells. Now, that wouldn't mean that you would pay if you were simply exporting. If you're based in one country and exporting through completely independent entities, that the company would be taxed where it had some business presence. But if you take, for example, Amazon, the separate entity principle now allows Amazon to have customer support in the UK, website support in the UK. It has a UK website, which is what you access. It has warehouses and delivery in the UK, but all the sales income go into Luxembourg. You probably know when you order from Amazon, your invoices all go to Amazon SARL. The separate entity principle allows you to do that. The unitary approach would say, well, we disregard those separate entities. If Amazon has UK affiliates, then the worldwide consolidated profit of Amazon would be apportioned according to its presence, according to the presence of whichever affiliates they may be. So instead of allowing them artificially to shift the profit to Luxembourg or Ireland, this would simply say, if you want a business presence, then you're taxed according to the real business presence in each jurisdiction. Now that could be done on as I say, building on profit split, using relevant drivers. You may have different drivers for different types of business sector. Most of the federal systems, for example, treat transportation businesses on the basis of usually passenger miles, for example. Finance business would be treated differently. But as far as possible, you would have this kind of standard formula. And then finally, you'd need to have some kind of procedure for settling disagreement. But that already exists in the current system too. We've already said the current system allows 5 different methods which are used in very disparate ways. And at the moment what you have is a so-called mutual agreement procedure through tax treaties. And that can be built on. What you also have is so-called advanced pricing agreements. Most countries now allow for that, which is one way to really deal with this dysfunctional system. The dysfunctional system really creates a lot of uncertainty for companies, and so one way to get around that is to negotiate an advanced pricing agreement. But companies don't necessarily like that. The big accounting firms love it, because it gives them good business. But it means that you have to really prepare a lot of documentation, and in a sense, bare your soul to the taxman. And they don't necessarily, they draft them very precisely. It doesn't spare you from future audits. So APAs, in one way, are a good thing in establishing certainty for companies. But they could be developed, I think, within a clearer framework of rules. APAs would be better. So I think what we need is not more regulation, but better regulation. Regulation that really reflects the reality of the business. How does it compare? There are obviously difficult issues, but they could all be resolved. The issues are on what basis would you define the tax base? What formula would be most appropriate? How would this affect government revenues? It would have the merit that it would leave countries free to fix their own tax rates. In a sense, there would still be tax competition, but it would be on a real basis. Countries could then decide, because the apportionment is based on real presence in the country, you could then decide, is it more important to have companies investing in your country and employing people and having a low tax rate, or having a higher tax rate and possibly discouraging investment. At the moment, the competition really is to offer spurious preferences, really, which are beggar thy neighbour approaches. So there are a number of issues about a unitary tax approach, but our view is that increasingly this will be looked at seriously. Really will emerge, I think, behind the scenes, if you like, from the OECD approach. There are a number of advantages and disadvantages. At the moment, large companies are fearful of it because they're still worried about the risk of inconsistent rules. It does offer them some benefit, and in particular, it would allow them to offset profits against losses in different countries. The disadvantage, it would give them fewer avoidance opportunities. So I think at the moment, they're still cautious about a unitary approach, largely because the present system, for all its dysfunctionality, which when they're frank, they will tell you they understand. That's not what they say to Margaret Hodge. If you look at some of the corporate tax people who went before the committees, I was flabbergasted at how they said, "Oh, the system's fine." Even the tax person at Glaxo, which had this 8-year dispute over $8 billion reallocation, but I don't think she was with them then. But the apparently very nice person who's now their top tax advisor said, "Oh, nothing wrong with the international tax rules." If you talk to them in private, they will admit that the system is broken, it needs fixing. The OECD is going to try and fix it with a lot of bandages, basically. A more logical approach, I think, would suit everybody much better. There are, I'd like to say, advantages and disadvantages other ways. The biggest losers would be the tax avoidance industry. In comparison with the OECD patchwork approach, if you like, the OECD is saying, oh, well, a unitary tax is a long-term solution, and so on. But the OECD approach is a long and difficult road too. They're not proposing to produce proposals until the end of 2015. And you've then got implementation. But also that will only be the start of it. As I say, by strengthening all the rules, you're going to have to see how this creaking machine will then work. And our view is it would still be largely dysfunctional. And the unitary approach actually confronts some of the main issues much more directly. The only thing you can say about the OECD approach is it actually conceals a lot of those issues, usually in a lot of technical debate. Not many people have got the time, energy or resources to track all these different proposals. Unitary tax puts all the issues on the table, and we would say that really this is what the governance system ought to address. It would be a much more effective basis. And if we go back to the discussion about law and morality, I mean, a lot of the discussion about morality was about the complexity of the rules and how far can you take advantage of the example that was given at the end of that session this morning was, you know, a very complicated set of rules which maybe inadvertently allowed you to reorganize. Well, that results really from over-regulation. And over-regulation really, in my view, starts from the rules being based on an inappropriate basis. If you start from separate entity, inevitably the rules have got more and more complex and more unsuitable. The reason for these 5 transfer pricing methods is because the separate entity principle makes no sense. So it leads really to over-regulation. If you can set the rules on a more sensible basis that is based on business reality, they don't need to be that complicated, and people will be a lot clearer about what the aim is, and you can then get much clearer agreement on the morality also of it. So I agree with a lot of what was said this morning, that the first step is to get the rules right. But getting the rules right is the responsibility of all of us. We can't just hand it over to the politician. Thank you very much.